this is our investment conversations and our market conversations, and we do have several of these throughout the year, but we also try to have webinars and bring in experts in other areas, social security, estate planning, identity protection, some big things going on now. We're going to be doing one on P&C insurance, right? The least interesting thing of life, but a very essential one. So you'll see some of those are on our website or recorded as well. But I don't want to drift too far from tonight's event. So some of the big things for tonight, we're going to do our usual conversations of what is going on in the world and how has that impacted our portfolios and how will it impact things as we go forward in the year. But another very important goal is to find out who is Nick, who is one of Adam's, if you will, heir apparent. And so it's not unusual in our industry to have a portfolio manager changeover. I will say it's been a great and somewhat unusual relationship with Adam, as many of you have really gotten to know him and been close with him. So Nick will have some big shoes to fill in that aspect, but as I said, it's not unusual in the industry. And so as a company as well, we have systems in place that for the next couple quarters, just for Nick to know, we keep a extra close eye on the portfolios. We put them on what we call our watch list. So it would be something that we'll keep focused on.
Yep.
But
no, he knows he's filling big shoes.
He does know he's filling some big shoes. I happily, though, we've had several conversations already with Nick and have built a comfort level there, and he's already reviewed all the portfolios, has a very similar mindset to Adam, and I'll let you give a broader explanation of that. But one of the things you had said that gave us some comfort, Steve, Luke, and Mike and I, is reviewing the portfolios. There was no, oh, why would you own this, or why don't you own this? It was, oh, I would have 10% of that, and he has 8. So similar mindset. Another big thing that gave us some comfort is Nick has been using the same team and will continue to use the same team that Adam has had in place. So the example I gave to someone earlier is a football analogy for keeping the offensive line, keeping the wide receivers, the tight end, the coach. It's the quarterback that's changing, and it's a quarterback that's already familiar with the rest of the team. So that's something, too, that we have a good eye on. And Rochdale has a lot of different things that they offer that are hard to find anywhere else to begin with. And one of them that Nick also has experience in is several of your portfolios have significant bond allocation, right, which is really important right now as we approach the elections and as there's interest rate fluctuations. And Nick has experience at a bond desk, which is not something you always see with portfolio managers. So there's several reasons that I'm excited to have Nick talk today. I did tell him that he can spend more time than usual introducing himself for this event, and to feel free for any of you to ask him questions. It will be very similar how we've always run this. So just he'll go through some topics that we've talked about in advance. But if you have questions, please feel free to ask and just get to know what he's thinking, what the team's thinking. One last thing I'll say with Nick that I thought was very impressive. He is on the side is also a professor at Columbia, so that they bring in some smart people there as well. So many other varied interests outside of just the investment world. That Nick, let you do the rest of the introduction.
Great. Okay. Pleasure to meet everybody. And that fire is going to get warm, so I'm going to take an extra step forward. I can feel it just from my chair, and especially if I'm going to stand here for a little bit. So nice to meet everybody. I met a few of you already. If I haven't met you in person, please say hello at some point. We'd just love to interact with everybody. Part of the reason why I do my job is not just stocks and bonds, while I certainly love that. I like the people aspect too, right? I can't be the person who sits in a room with no windows and never sees anybody. Like, that's just not my personality, right? So I like to interact with people, and everybody's in a little bit of a different situation. And even where you are today, right, your financial picture always evolves, and that's part of the reason why we work together with the Brophy team, right? It's not just a set it and forget it, right? Things evolve, markets evolve, your financial picture evolves, and we want to make sure that we're part of it. As far as just prepared remarks for me, maybe I'll just say a couple of items for myself, then maybe we'll do some items on an economic overview, and then maybe some thoughts on markets. I think those are kind of three categories. That generally makes sense. Feel good about that? I see some nodding. And then any questions, we can certainly have that. Happy to take whatever it is, from an individual stock to an economy to the election. Right, I get the election question pretty much every AM and PM for the past 12 months, so I'm certainly happy to bring that into the mix as well. So part one, about me. I'm originally from Syracuse, New York, born and raised, so we had a conversation about football earlier, right? So happy to root for college football there. But I lived in the city for 10 years, and now my wife and I and my little girl, we live in northern New Jersey. So that's kind of where we are. And I mentioned, I think earlier to Ginny and David, right, it's my little girl's first Halloween, right? So we've got a little bumblebee costume for her, and my wife and I are in the beekeeper outfits, so we're going to make sure that it's memorable, right? So that's the family life there. I do the part-time teaching, usually once a summer for Columbia. That is a course primarily for high school students, which is a little bit of a surprise, right? Normally when people say, oh, it's the university, it's for university students, but in high school, one of the arms races to get into college now is not only you have to have the good boards and the good grades, is now students are enrolling in classes to also put on their resume, hey, I took a 1-week class or a 2-week class or a month-long class at a university. And my goodness, the universities make a lot of money on those types of programs. So that's an interesting angle, and I've been happy to be a part of that for Columbia there. As far as the career, first job out of school was working in finance for Lockheed Martin, defense contractor. And then I chased a little bit more the career for the investments world. So I worked on my CFA, I have that, I have the CPWA. So I have my 2 big credentials there, both on the investment side and the wealth side. And started off working for Morningstar, which I think a lot of you are familiar with the company, so I lived in Chicago. Did that for a year. I covered regional banks and specialty finance companies during 2008. And if we think back to 2008, that was a very interesting time for all things financial, right? So it was very interesting to get a front row seat and have CEOs and CFOs pretty much yelling through the phone that we didn't publish something that was kind enough of a report to them. But one of the things I take a little bit of pride in is I had about 24 companies on my research list, and I didn't have a buy rating on any of them the entire time I was there, which was the correct call because pretty much every financial stock really struggled in 2008. So that was a good opening leg there for the first part of my career. Worked at PNC Bank for a few stints. At one point, I had my own investments website and followers across 24 countries. Kind of had to put that amateur hobby away and then follow it full time. I've worked on a bond desk, as James mentioned, also for PNC Bank. Pretty much that was during 2012, and that was in a very low interest rate environment. So everybody was chasing for bonds, and we can have a bonds conversation. But there were days where we would go to buy bonds, and you couldn't buy any because there just wasn't enough out there. Right? So I had a front row experience to that, gosh, a little over a decade ago, although it feels like yesterday. And then I've been with City National for 10 years. So I've done the portfolio management side the entire time, came in as an associate, been promoted a few times, and I've been running a book of business. This is now my 5th year, and I've known Adam all 10 years. And I've probably told some of you earlier, I can stick my head out my office and kind of look down the hall and see Adam's old office, right? And the people who are on our team are the folks in between there. So, his 3 associates, Anthony, Stephen, David, I mean, those are the 3 guys who I also rely on. Vivian also helps with scheduling too. So that team is the same. We have the same research team. We have the same trade desk. And Adam and I at one point had the same boss. So we're really cut from the same cloth there and happy to really be taking part here and helping out with all of you folks going forward. Any questions on the background or the handoff from Adam to me? We feel pretty good about that? Okay, all right. I got to sit down now. Beautiful. So let's do an economics overview. A lot of you have seen our speedometers that we publish every month, the green, yellow, red. Yes. So most of those are green and yellow. We have 2 reds on the page. For those of you who are unfamiliar, every month we publish an economic outlook. And it's 20 indicators that you would expect to see for the economy. There's the consumer and the job market, sentiment and inflation and interest rates, like everything that you would want to look at on there. Most of it is green or yellow. So we do think that the economy is currently in a good spot for this year and probably through the end of next year. And what I mean by a good spot, we're probably looking at growth at about 1.5% to 2%, which doesn't sound very exciting, right? Usually you want 3 or 4, right? That would be something more exciting. But the reality is the rest of the world, at least the major countries, are flat, right? So when we look at Japan or the United Kingdom or Germany, it's pretty much flat, or in some cases negative. So if the US is at about 1.5% to 2%, we'll take it. I would love to have more, but that's pretty much a good outlook for us. The drivers of the economic growth, it's the consumer, and it's the ability for corporations to continue to grow on their bottom line. Those are the two big drivers. And if you've ever looked on the speedometers, those are the two that are in the middle of the page. And those are the two, when I have a conversation, I point to first. It's what's the consumer doing and how are corporations doing in that environment. At the end of the day, the growth of profits, right, your corporate profit growth, the amount of money that companies make, that's ultimately what helps to drive the stock prices higher. It doesn't go in a straight line, and sometimes it zigs and zags, but you have to have a company that's actually making money over time for that stock price to really move higher. That's kind of the causality and the driver there. Right? There's always exceptions to the rule with meme stocks and things of that nature, but we like what we're seeing there. Job market looks pretty good. We had a very strong number earlier in the week. Somebody was asking me about interest rates earlier. The jobs data that we had earlier this month is actually moving, parts of the bond market in a positive direction, so all things look good there. The big question that I think everybody's thinking about is, well, what about the political environment, right? What about the election? The answer that our CIO and our marketing team and our company likes to say is tariffs, treasuries, and taxes, right? Those are the 3 things that matter. I'll be more explicit. Follow the money, right? See where the money goes, and not only at the White House, but also what happens in Congress. Because Congress ultimately is doling out the money that actually flows into the economy, right? So whether or not you have a Team Harris or Team Trump, I also want to see what happens in the Senate and what happens in the House, right? Because you could have somebody come in and have their plans all day, but Congress could thwart their plans if you're not all on the same side. So when we construct portfolios, we're not building the Harris or the Trump portfolio. We're building the portfolio that's best for each person here, right? And what we want to see out of that is some of the best and strongest companies that are out there, right? Think of the Microsofts and the NVIDIAs and the Apples of the world and JP Morgan and Home Depot and McDonald's, right? All of those companies are tremendously profitable, right? They make 10, 20, 30, 40% ROEs every year. So I want to have those good companies, and if we can get them at a fair or a good price, then I want that to be the backbone of the stock portfolio, right? If we then see something from Congress where we see a policy in the form of a subsidy or a tax cut that is going to positively impact an industry or a certain company, then we'll certainly take that into account, but we're not going to chase a bad company with government dollars. Right? I'm just not interested in doing that. I don't think it's a good use of capital. I'd rather own some of the higher quality businesses that are out there. All right? So that's kind of how I would think about the election with respect to portfolio construction there. Similarly on the bonds, I'm not looking to hit home runs in the bond side of the portfolio. The bonds really should be boring. Right? If there's excitement, I want the excitement on the stocks because that's where you get your upside. If there's something exciting in the bonds, that's usually not a good story. Right? So we're looking for boring, we're looking for a yawn, we're looking for vanilla, right? Just good quality corporate bonds. Think about companies like Amazon and Nike and Tyson Foods or Citigroup. Right? When you own that individual bond, really the only way you lose is if that company goes completely out of business. Right? If you own a bond and it's Amazon, Amazon has to go out of business for them not to repay you that bond, right? And that's a really different world if people can't buy things on Amazon. We'd have revolts, right? So that's your low risk, low to medium reward type of a trade-off that we're looking for in the bond market, all right? Last item on the economic front I'll mention is just some of the geopolitical risks, right? Because you can't turn on the news and not see some of the flare-ups that are going on around the world. When I think about the ones that are most impactful from an economic perspective, Eastern Europe, right, Russia, Ukraine, for sure, and then also what's happening in the Red Sea, right, and you can say more broadly Israel and also Iran and other Gulf states, I'll say jockeying for position. Both of those have huge economic impacts, right? So for example, the Suez Canal has been closed for over a year. So if you're a business in Germany or Italy or in Europe, and you need to have raw materials coming in from Asia, it's not going through the Suez Canal. It's going the extra 3-week journey all the way around Africa. Right? So there's an extra freight cost to that as a business owner. Right? Furthermore, you don't know what's going to end up in Eastern Europe, whether it be from energy or just international policy and how that shakes out. So there's some extra risks there investing internationally. And I use Europe because Europe is the next biggest economy. In our portfolios, we are currently not allocating to international markets because of those extra risks. Right? So if you look through the Rochdale portfolios, you'll see overwhelmingly a U.S. presence. That's by design. Right? It's also been the right call. I think 8 out of the past 10 years, U.S. has outperformed Europe. Right? That is a much more important call to your portfolio than whether or not we buy Coca-Cola versus Pepsi. Right? I believe U.S. has outperformed Europe by about 15% this year and 8% last year. So those are big numbers, right? So when you see the numbers in the portfolios go up, yes, we're owning good companies and good stocks, but we're also purposefully avoiding other parts of the world that haven't done as well. Right? So I point that out because it doesn't always show up on the page, but those are the reasons why we've avoided Europe and some other areas because of the geopolitical risks. Looking forward, is it possible that we revisit international markets as an investment next year? Yes. We'll look at it. Does it mean we have to invest in it? No. It has to be the right opportunity. It has to be a good theme. It has to be a good business setup. We have to have good management. Right? We have to check all of those boxes before we sell a good U.S. company to go buy something overseas. Right? So the thesis has to work out there. If we make that change, we'll absolutely be in communication. Those are the types of things where we want to have good transparency, but I want to let you know how we think about things. Right? So we've talked about all things economic related. I'm happy to go into markets. Any questions on anything related to the economy or that I touched on there? I feel like I'm going a little fast. Yes, sir, David.
Our relations with China. Where's China and the geopolitical issues about how that's going to affect?
One of the nice things that we have in the U.S. is a friendly environment towards shareholders. In China, we don't have that. Right? So there's a risk there. And even if we did an international investment next year, I would be surprised if it included China. It's just not something that we think makes sense from a risk-reward perspective today.
Does that have a secondary impact on other kinds of
Maybe.
decisions?
Maybe. I think the bigger driver there would probably be demographics. And then you start to get into a whole host of other countries that might look attractive from a demographic perspective, right? Whether that's India, Indonesia, Vietnam, Philippines, and then you also have to have good companies, right? You can't just say, oh, this is a good country, I want to invest in it, and then you find out, well, there's some other flaws down the road, right? It has to, end to end, it has to be a good investment. But we're aware of it, but right now, probably not our favorite place to go. That's on the stock side. The analysis for bonds is sometimes a little bit different, right? Because stocks, you want the stock to go up. But bonds, you just want to make sure you get your money back, right? So the analysis might be a little bit different there. So we might dabble in some emerging market debt, but it would have to still go through the same rigorous process for us to do it. The investment has to make sense, and it has to make sense in each portfolio. Right? There's no shortcuts on that. All right. Yes, sir. Vicky.
I forgot. I'd like to bring it back to the political environment, and so leaving the social implications aside, focusing only on policy and how it affects money. Would a Republican versus Democratic win change, or are you guys looking at that to figure out in the next 4 years or whatever it is, and I understand this Congress, Senate, all of that, right? Policies actually have to pass before, blah, blah, blah. But words make a difference. They change markets, right? So is there some calculus that if a Democrat wins, we would lean towards these companies versus if a Republican wins, we would lean towards some other company?
It's not as straightforward as maybe folks on TV might want you to believe. The reality is, once you go past 12 months from an economic forecast, the amount of variables that could come into play are enormous, right? And that's part of the reason why we don't publish or really look at things that are 4 years, 10 years out. Because again, demographics is probably one of the bigger ones, and I would say technology or technological change, right? 4 years ago, at this conversation or conversations that you had, how many people were having the conversation about AI, right? So those are the types of things that, you know, you could have a whole new invention 2 years from now, and it would really supersede, you know, potentially who's in office there. So we're aware of it, but beyond 12 months is really difficult just because the variability is so wide.
Okay, I mean, just to give you a counter, right, I would never invest in the EV market. It was the Republican president, right?
You can make an argument for or against, right? Because you could say, oh my goodness, coal has done really well under Biden.
That's right.
Right?
That's right.
Which is not what you would expect. Or ammunition and guns manufacturers did well under Obama, right? Again, not what you would expect, right? So I don't want to necessarily play those types of themes. We might potentially do one stock here or one stock there or one bond here or one bond there. Sure, right? That could make sense, right? If we add an extra bank or a financial into the portfolios because we think Trump might get in there, maybe, but we're not going to make huge changes to the portfolios. That to us isn't a game we really want to play, nor do I think you get a ton of reward out of it if you make a huge move like that.
It's only 4 years, so it doesn't matter.
Yeah. So, yes. What's your name?
Denise.
Denise, pleasure.
So Congress is clearly allocating a lot more than comes in as tax revenue, right? What do you think the impact of the ever-increasing national debt is going to be near term and maybe longer term?
Yes. So this is interesting. So the CBO, the Congressional Budget Office, just had a publication. Did you see it? It came out either earlier this week or last week on the fiscal year, right? So tax receipts the past year, this year, so they run on a fiscal calendar, were 11% higher than the year before. That's usually a good story. But despite 11% increase in revenues, the deficit has still grown by an extra 1.8 trillion, right? That's a lot. Trillion, right, with a T and a US dollar, right? It's not some other currency, right? On the debt side, yes. So the number one expenditure is Social Security payments. Number two is no longer Medicare or defense, it's the interest. Number two is interest, right? Medicare is number three. And then I think Medicaid and defense are kind of the next items down there. So the question really is on, well, what happens? Does something start to break, right? And for many years, we would always say, well, that's 10 years plus, right? I don't know that I can safely say that anymore. I don't think we have an immediate concern on our hand today because the US dollar is still king. Treasuries are still very much in demand. There's not really a competitor to the US dollar out there. Other countries have tried and they've really had some failures. As long as there's still buyers of the treasuries, you're good. I still think we have some runway on there. I would look to see if there is a lack of demand or waning demand in the treasury market or if something else was a challenger on the currency side. I don't see that today, but could we be in a scenario where 5 to 10 years from now, maybe that becomes a bigger item? Maybe. And so the thought there would be, well, what would we do from a portfolio perspective, right? So in that scenario, you either have one of three things or a combination. You either have higher inflation, higher prices, you either have higher rates, or you have a lower dollar, right? So all of them kind of come to the notion of, well, what's the price going to be? I want to own the highest quality companies that can withstand that type of an environment and that can also raise their prices. And we have a lot of those in portfolios. So think about companies like Pepsi or Procter & Gamble, right? Both of those companies, when we had high inflation over the past couple of years, were able to raise their prices meaningfully. And there's actually 24 companies that were able to do that. But if you're at the top of, you're the CEO of Pepsi, they were able to raise their prices 9% in 1 year, and they only saw volume drop off by 2%. So that's a +9 and a -2. You're +7, you're going to do that. And I want to own that company that can raise the price and the customers are still going to pay up for that product in pretty much the same amount, right? So that's why you'll probably hear us say high quality businesses. The pricing power really matters in pretty much all of those scenarios, right? Bonds, I'll have to see how that plays out, right? Because the bond market's going to be a little bit different with how rates move. But again, quality I think is going to be the best play there. Yeah. Is that helpful to your answer? Maybe I gave you a longer answer than you were expecting, but I think the longer answer, especially in this type of a forum, is better. Yes, sir. What's your name?
Ed.
Ed. Nice to meet you.
You said that there doesn't appear to be a contrasting currency, but the whole China, Russia, Iran relationship that has been growing lately could present that. Do you have any insight, thoughts, or comments on that?
Yes. So I'll give you a two-part answer. So part one is a lot of that has to deal with trade, right? So they're effectively aligning so that those countries can trade to each other. And the secret behind that is they're accepting each other's currencies, but then they're converting it into gold, right? So they're not hanging on to those currencies the entire time, right? So and then
don't hear that.
Right, right. And that's an important thing because as far as a huge challenge, right? We had a question earlier about, well, do we like Chinese stocks as an example, or we were kind of touching on that topic. If you don't have shareholder rights for the equities, there's also concerns about ownership rights of the currencies. And if you're trading with somebody and they immediately move out of that currency into a hard asset, then that's kind of a nice confirmation that, well, there's really not picking up much traction on the currency side. Right? So you can kind of look at these a couple of different ways and you should be able to argue it out and follow the logic there, but that would be my answer to it. So yes, we're aware of it. As far as the staying power of it, not concerned today. I'd have to see a lot more trust among those nations in holding those currencies before I'd be concerned about that. I don't think we're there, and I don't think we're there in the next couple of years either.
Hence, good companies in the U.S.
Right. And it's also more of an argument for the U.S. dollar sustaining in that environment. Right. So.
That's a great point. I didn't realize that they were converting it back to gold.
Yeah. Oh, yes. Yeah. So, yeah, we didn't know when we signed up we were going to get a good currency conversation for tonight, right? Right. All right. So go forward here. As far as outlook, I said it earlier. We like the high quality companies. We like the U.S. We've had a really good market this year and last year. Pretty much, rising tide lifts all boats. I still like owning the highest quality companies because if, let's say, for whatever reason, election, earnings season, Fed policy, we've got a lot of events in the next 3 weeks, right? If we get a reversal in some capacity, I'd rather still be with the highest quality companies there. The market's up, 20% plus this year. I don't think we get a 20% every 10 months, right? That's just not a good pace to keep up with. But we are penciling in high single digits for stocks over the next, call it 12 months or so, right? We think it's positive. I just don't think the same pace continues. And then bonds, we think bonds also do well. Investment grade bonds roughly yield about, call it 4.5%. And if rates continue to fall, which we think they will, maybe you get a little bit more there. So, could we see a 5-ish type of return over the next year or so? I would kind of anchor there and kind of go up or down. But overall, we are pretty positive on both stocks and bonds as we go forward. All right. Any other questions? We feel good? Yes,
Yeah,
James.
We're starting to see some shifting from municipal bonds to corporate bonds. Is that something that you're seeing as well? And is that more just a difference in the interest that they're paying versus strength and the quality of the bonds?
You're saying you're observing that just in the marketplace?
Right.
Yeah. It depends on primarily what the tax rate is of the bond owner. And that evolves too, right? The answer that I could give you today could be different next week if the rates change. Generally speaking, municipal bonds tend to make the most sense if you're in more of a higher tax state and in one of the top 2 tax brackets, so 35%, 37%. Less than that, if you're in the 28, 32 at this point in time, we are preferring the corporate bonds. So kind of to take it a high level to understand the question is, do we like bonds that have a high yield but you pay the tax, or do you have bonds that have lower yield but don't pay the tax, right? And for most folks, it makes sense to have the higher yield and pay the tax, right? And look, nobody likes paying taxes, but you're generally in a better position if you were to get the municipals, unless you're in the highest tax brackets. Right? Okay. Yes.
Yeah, a couple. So many of the portfolios where there's core equity for stocks, equity income for stocks, which are dividend drivers and things of that nature. Some bonds and small mid-index. Okay, and so we might plan that we need a 6 or 7% growth to make the client's financial plan work. In other words, they'll always be financially independent. With that kind of return. But if the market's up 20 and they're up 18, it's like they're a dog. So in the past, when we looked at it, we saw like a lot of the equity income portfolios were out of favor.
Yes.
Right? So then the bond portfolios came in as a substitute, perhaps opportunistic, that maybe we hold the bonds, interest rates will fall, we'll get our 5% because the yields are up, and then maybe we'll pick up another 3 to 5% in price appreciation. Are you holding bonds now for the opportunistic side? Are you holding them now to add some stability to the portfolio, increasing the crises?
Yeah. So really, the question is, why would we own bonds? Right. Broadly speaking, preservation and cash flow are the two primary reasons. Could you play a movement in rates? Maybe, but I'd rather use that extra capital on the stock side, either on the growth stocks or the dividend stocks. Right. So it's preservation, cash flow, and I'm pretty straight vanilla when it comes to the bonds. I'm not looking to take a ton of chances there. We have some high yield strategies. We have some alternative strategies that are bond-like in nature, and that can be appropriate for folks who want a little bit more juice or want a little bit more income. But that would be how I would think about it there.
I just want to follow up on that, the small to big cap,
Yes.
quality companies in that area. Where do you see them falling, whether it's in your portfolios, number one, and number two, from an economic perspective over 12 months?
Oh, gosh. Mid-cap seems to be like the kid on the playground who just does something different every time at recess. Right? You just kind of like, you think they're going to do one thing and they do something else. I think I could give you three answers and they'd all be valid. The reality is, in a good environment, in a good economy, smaller and medium-sized businesses tend to do better. Right? In an environment where interest rates are falling, small businesses can refinance and those tend to do better. Right? So you could have a good runway for small cap and mid cap. The counter argument to that is pretty much everyone's buying the Mag 7, right? The Magnificent Seven names, right? At the top of the market, and large caps in favor, and you have some forced buyers in there. So mid cap still could do well, but it still might lag the overall market. So I don't know if that's the answer that you wanted to hear, but that's the best answer I think I can give you on that. Yeah. So did I cover everything? Okay, you got to, Denise, yes, one more.
So, what do you think the impact of AI is going to be on your industry? Given the huge investment that the financial
I know, if there, I mean, might there be a hologram here next year instead of me driving up for the trip?
How do you see it being valuable to you, or not?
I think it's a little early to tell. And I don't want to just say that as a way to kind of get out of the answer, but the reality is the application and number and types of use cases, I still don't think we know what it is. I think we'll have to see on that one. I hope I have a broader answer for you next year, but I don't want to guess, and I don't want to be wrong on that one. It's still in its infancy, and I was having a conversation earlier. We don't think it's a fad, right? If you remember back a decade ago, my favorite example was 3D printing, right? We were all supposed to have a 3D printer in our home, and it was supposed to make all these wonderful things every day for us, right? I don't own a 3D printer, and that seems to have come and gone, right? The non-fungible tokens, right? That was a theme. Cannabis, that was a theme, right? Artificial intelligence, I think, has legs, right? That one I think has some use cases that we'll see. Okay. So overall, you got to know about me a little bit. I hope to meet more of you. Got a good overview of the economy, pretty bright so far. Good outlook going forward for the markets. And I think we'll just kind of summarize it there.